An investor known for The Big Short questions whether we are still too bullish.
I think there are a lot of good things going forward in the market. Just start the year psychologically, everybody is just a little too freaking happy.
She says this job is making me unhappy.
But you're happy when you're unhappy.
I am happy when I'm unhappy.
Steve Eisman, famously portrayed by Steve Carell in The Big Short, was back on CNBC this week to share his insights on the stock market and the economy as we enter 2024. The senior portfolio manager of Neuberger Berman was one of the few people who correctly predicted the collapse of the US housing market in 2008. In his most recent interview, he explains how strong economic expectations could lead to a disappointing year for investors if the over-optimism isn't met. He also talks about the importance of AI and the Magnificent Seven companies that are driving the market, the growing US national debt, as well as which industries he's investing in. This video is sponsored by BetterHelp. More on this later in the video.
You think that market fundamentals are actually good, but overall sentiment is too bullish? How do you distinguish?
Well, I mean, think of it this way. Let's say we were here a year ago. Most of your guests would have come in and said the earnings of the S&P are going to be down. The market's going to be down. The economy is going to go into a recession in about 15 seconds. And none of that happened. The recession that never was. And so the market climbed the wall of worry the whole year.
The outlook on the markets at the beginning of 2023 was fairly negative, and that couldn't have been more wrong. S&P 500 earnings were expected to be down, but as of the third quarter earnings reports, American public companies saw their profits rise by almost 7%. The most predicted recession ever didn't happen, with US gross domestic product rising 2.6% above inflation, and unemployment remains at a historic low of 3.7%. So as the outlook for the markets shifted from fairly negative to fairly positive, financial markets saw considerable rallies throughout 2023. At the beginning of the year, the price-to-earnings ratio of the S&P was about 22. It's now increased to almost 26, an 18% increase in stocks driven by that shift in sentiment. The S&P in total rose about 24% in 2023, meaning if you held an index fund ETF, about 75% of the increase had nothing to do with companies earning more profit, but rather a reflection of the outlook changing from negative to positive. The year before, in 2022, the price-to-earnings ratio of the S&P started and ended the year at 22, while earnings declined about 13%, resulting in the stock market that was down about that much. So over the last couple of years, we've seen two very distinct types of markets. In 2022, we saw a market that was driven down almost entirely by a decline in earnings, and in 2023, we saw a market that went up significantly, partially because of earnings, but also because of a shift in sentiment. The thing to watch in 2024 is the potential for us to see something we haven't yet, both earnings and expectations driving markets down.
So now here we are a year later, and everybody is, including me, has a pretty benign view of the economy. The only thing that bothers me is just that I don't think we're necessarily wrong on the economy. I think we're probably right. It's just everybody's coming to the year so bullish that if there are any disappointments, what's going to hold the market up?
Eisman's view is that the economy could still do well in 2024, but with the expectations so high, there's a chance that we could see a reversal in optimism. A large part of the current optimism is related to the Fed and what happens with rate cuts.
The market seems to think the Fed's going to cut rates at least 3 times this year. At this point, don't have that view.
At the latest FOMC meeting, we learned that the Fed committee members currently expect to cut rates from the current 5.25 to 5.5% range to 4.6% by the end of the year, with most members expecting rates to be between 4.25 and 5%. And financial markets have completely priced in that expectation. A 1-year US Treasury bond rate is 4.7%, indicating that investors believe the federal funds rate will be about 4.6% in 12 months' time. And even more bullish, the 2 to 4 month bond rates indicate the market is expecting the first rate cut to happen as soon as March. And instead of expecting a decline in corporate earnings as the market did at the start of last year, the current analyst consensus is for earnings to grow 11 to 12%.
What is right in your view? Because the market believes that there's going to be probably at least 2 and maybe 3 at this point.
I think the best, if you had to lay your life on the line, I'd say 1. Unless there's a recession. If there's no recession, I don't see any reason why the Fed needs to be aggressive at cutting rate. I think the Fed is still petrified of making the mistake that Volcker made in the early 80s, where he stopped raising rates and inflation got out of control again. So I'm not that bullish on the Fed cutting rates. So if I'm in Powell's seat, I pat myself on the back and say, job well done. And my real risk is that I cut rates and inflation resurges, and then I have a real problem.
Of course, if you're listening to these clips, the idea here isn't to listen to one person's opinion and take it as gospel and make short-term changes of your investments. That would be called trying to time the market, something that has never been a reliable strategy. But listening to Eisman helps us understand how the market works in the short term so that you can manage your expectations. Don't be surprised or upset if the market has a bad year this year. It means absolutely nothing if you're a long-term investor.
But I think long-term I'm still very bullish, but near-term I just worry that everybody's coming to the year, feeling too good.
Before we get to more of the Steve Eisman interview, I just want to pause quickly to talk about the sponsor of today's video, BetterHelp. If you're feeling stressed or anxious, don't just hope those feelings will fade away. Trust me, ignoring them will make things much worse. I know this because I've been there. I struggle with social anxiety and I've had relationship issues in the past. And like many men, I found it tough to open up to those around me. And that's where I discovered therapy. It was a game changer, an anonymous, safe space where I could really work through my emotions. Many people think that therapy is only there for severe mental health issues, but that's not true. It's also there for everyday feelings that you might think are just a part of normal life. And that's why I'm introducing you to BetterHelp, today's sponsor. BetterHelp is incredibly effective. Over 4 million people have used it to lead happier, healthier lives. Here's how it works. Go to betterhelp.com/Hamish Hodder, answer a few questions, and they'll match you with a licensed therapist specializing in your struggles, in most cases within 48 hours. You see, therapy isn't just about talking. It's about understanding yourself, developing coping skills, and creating a plan for a better life. It's about talking to someone experienced in helping people just like you without feeling like you're burdening your friends or family. BetterHelp lets you take control of your life comfortably from your phone or computer through calls, video chats, or messaging. It's the easiest way to start therapy. I believe in mental health and what therapy can do for you as it did for me. So if this sounds right to you, visit betterhelp.com/Hamish Hodder. It's in my description too, and you can get 10% off your first month.
And you think about what generative AI did to the stock market this year, right?
Yes.
And that's really what infected the Magnificent Seven and really buoyed the stock market in a year where you just mentioned earnings. They didn't grow much this year. So my question to you now is that the stock market has realized a lot of the enthusiasm about this technology. What do you expect it to do in 2024 for actual earnings?
Other than NVIDIA and maybe AMD and, maybe some Microsoft, I don't think you're going to see that much of an impact on earnings in tech yet.
You can really split the results of public companies into two groups: Apple, Amazon, Microsoft, Alphabet, Meta, Nvidia, and Tesla, and then just the rest of the S&P 500. While the earnings growth estimate for the entire S&P is about 11 to 12%, the Magnificent Seven are expected to grow earnings by 20.8%, and the rest of the market by just 6.7%. At least for right now, Nvidia is clearly the biggest beneficiary of the artificial intelligence boom. Their data center revenue, which includes the sale of graphics chips that form the technology foundation for generative AI models, reached a record $4.3 billion in the first quarter of 2023. It then rose 141% in 3 months to $10.3 billion, and then another 41% in Q3 to reach $14.51 billion. More than a tripling in revenue in just 6 months as companies build out their AI infrastructure. And even more crazy, year on year, Nvidia's earnings are up over 1,000%.
It's still going to be very story driven. What I'm most curious about is, other than the very, very large tech companies, nobody really yet has a real AI story to tell. And the question is anybody going to emerge?
It's still very early in the AI revolution to know which companies are going to benefit the most. In fact, it's likely that many of the companies that we will associate with AI in 10 or 20 years, it's likely many of them don't currently exist. The internet opened up to the public in the early 90s, but most of the big internet companies we know today weren't founded until the early 2000s. And a big part of that was the technology limitations on which kinds of internet companies could even exist and operate. Take YouTube or Netflix, for example. Neither of those services were even possible until around 2005, when internet speeds were capable of handling video streaming at a reasonable bandwidth. So in the same way, the capabilities of AI AI, and therefore the companies leading the way, will probably look very different in 1 or 2 decades.
Steve, as we sit here, U.S. debt just went over $34 trillion today. Is there a scenario where there's a debt concern, debt problem in 2024, some sort of credit crisis that you're looking at?
100% no.
Unlike some other smart people looking at the US debt situation, Eisman doesn't believe it's an issue at all. That's despite the national debt reaching $34 trillion recently, with a debt to GDP ratio of 123, and with an average interest rate on that debt almost doubling since 2021 from 1.6% to 2.97%.
You know, in our business, we like to say being too early is the equivalent of being wrong. And there have been plenty of times in my career where I've been too early. But I'm not 40 years too early. And, you know, the people who are making this argument about U.S. debt have literally been making this argument for the last 30 to 40 years. There's absolutely no evidence whatsoever that the dollar is going to lose its reserve currency status. People still want to buy U.S. debt. They're not replacing it with Chinese debt. So, you know, until there's a real problem in the U.S. bond market, I think we're just fine.
Eisman was also asked about the banking sector, which he called uninvestable in an interview just a few months earlier.
I've said many times the banks right now are uninvestable, and it's 3 reasons. Number one, they're losing deposits.
Okay.
So net interest margins are going down. Loan growth is tepid at best because they're losing deposits. And the regulators have raised capital requirements again, and that's not even hit returns, and they won't hit returns till sometime next year or the year afterwards. And we haven't even had a credit cycle yet.
Eisman doesn't think that the large US banks will face a problem like some of the regional banks did in early 2023, but he does think they'll have a hard time growing earnings for a fairly simple reason. Deposits at commercial banks have been declining since mid-2022, which limits their ability to issue loans. And after the pandemic, a lot of bank assets went into very long-term treasury bonds at rock-bottom interest rates.
Bank of America is a very well-run bank. It's got a very good CEO. That doesn't mean they haven't made mistakes. They bought a hell of a lot of long-term bonds at the wrong point in the cycle. It's not a balance sheet problem. It's more of an earnings problem. So the earnings, if you look, are basically flattish for the last few years, up and down by just a little bit percentage.
So he doesn't like the banks, but what areas does Eisman find attractive heading into 2024?
I still think, you know, you have to have at least a significant percentage of your assets in the Magnificent Seven.
Eisman still likes the Magnificent Seven, and well, if you're an index fund investor with some money in the S&P 500, you'll continue to have a large exposure to those 7 stocks. The total value of the S&P 500 is about $40 trillion, and over $12 trillion of that is the Magnificent Seven. So about 30% of your money is in the Magnificent Seven if you own an S&P 500 ETF.
And there are other themes that we also really talk to our investors about, like infrastructure. $1.2 trillion is still going to get spent in the United States over the next 10 years. First time we've had a industrial policy in the United States of America, probably since anybody in this room's been alive.
Eisman has been talking about infrastructure for a while now, and it's clearly a focus point for his fund over the next couple of years. And if you're interested in hearing more about that, check out this video next. Around the 11.5-minute mark, I share a podcast clip where Eisman discussed his infrastructure play in more detail.